Hey, what's going on everybody? Welcome back to the channel. I'm Waller's Wallet, and if you're someone who's new to investing, or maybe you just want a true set it and forget it way to invest, you might be thinking about a robo-investor or a robo-advisor. So in this video, we're gonna take a look at a few robo-advisors and see how they compare, and are they even a good idea? Now, if you want to simply help out the channel, consider hitting that thumbs up button. Also, don't forget to subscribe to the channel and turn that bell notification on as well so you don't miss out on future video. Now, it is 2021 and automating things in your life just seems to be a growing trend. And robo-investing seems to be a nice way to make investing easier, and there are a lot of different options to choose from. And in this video, we're going to look at Betterment, Wealthfront, Schwab Intelligence Portfolio, and Vanguard's Digital Advisor. Now, I have excluded M1, not because I don't think it's a good app or platform, I think it is, but I don't think it's a true robo-advisor because it's not fully automated. You do need to decide when you want to rebalance your portfolio, and it lacks other benefits as well. But I do think M1 is solid, and I'll have a separate video on M1 in the future. Now, if you're looking at these options, the amount of money you need to get started using one of these robo-advisors, it's going to be different. And Schwab's Intelligence Portfolio requires at least $5,000 in order to enroll in the robo-advisor. Now, you can get access to their premium version with $25,000 in your accounts, and this gets you benefits like one-on-one unlimited guidance from a certified planner. Vanguard's Digital Advisor requires at least $3,000 in a Vanguard's brokerage account, and those could include accounts like taxable accounts, traditional IRAs, Roth IRAs, and rollover IRAs. Betterment has no account minimums in order to open an account. And this is great, especially if you don't have $3,000 or $5,000 lying around to invest in Schwab or Vanguard. Then Wealthfront, it does have an account minimum of $500 to open an account. So this could be a barrier for some, but it is a lower cost than either Schwab or Vanguard to get started. Now, without question, getting started with Betterment is going to be the easiest option since there's no account minimum. Both Schwab and Vanguard are definitely going to be more limiting for investors who don't have the capital to invest right now. Now, the reality is that most of these robo accounts charge fees to manage your portfolios and to take advantage of their benefits. And these fees are usually lower than what a traditional advisor would cost you. And these advisory fees are in addition to the expense ratios for these ETFs. Now, Schwab's Intelligence Portfolio charges customers no fees to use a robo-advisor, which is great because all the other options we're comparing charges fees which are going to vary. Now, if you are a premium member, there is a one-time $300 fee, then a $30 monthly fee. So since this is a flat fee, the percentage is going to vary based on how much money you have invested in those accounts. Meaning the more money you have in there, the lower it's going to be in terms of a percentage. And you don't have to sign up for this account even if you meet the investment requirements if you don't want to. Now, for Vanguard's Digital Advisor, this is not a fee-free account, but the fee, it's not unreasonable. Vanguard does say it charges a 0.15% fee to use their robo-advisor, but it actually looks to be closer to a 0.2% fee, and they could credit you back some money, with their goal being around a net 0.15% fee. So this could range depending on what they credit you back. Now, Betterment, it does have a 0.25% yearly fee, which breaks down to $25 for every $10,000 you have invested with them. They also do offer a premium plan, but that has a 0.4% annual fee when you reach a $100,000 investment. And again, you can choose this option if you want to, you're not required to. Then Wealthfront, it does also have a 0.25% yearly fee just like Betterment, and that is the only fee they charge. They don't have a higher premium plan, it's just this one fee. Now for fees, Schwab does look to lead the way here since it charges no fees. But I do think this could be a little bit misleading, and you'll see how when we get to see how Schwab invests your money. Vanguard would be right behind Schwab here with its 0.15 to 0.2% fee. Now, both Betterment and Wealthfront do have the highest fees at a 0.25%, but they also do offer referral programs where you can either get free time or free money for your assets managed. So this could help offset some of those costs, but in the end, their fees are still higher than the other two. Now, many robo-advisors use cost-effective ETFs to build out your portfolio, and how they build out these portfolios and allocate them is going to be different based on numerous factors, including your age and things like risk tolerance. And the funds which those portfolios could also be using could be different as well. Schwab offers 3 different investment strategies and 6 different risk profiles ranging from conservative to aggressive growth. And Schwab helps you decide your risk tolerance after you answer just a couple of questions. And there are 51 potential ETFs that could be part of your portfolio. Obviously, Schwab ETFs are part of their plan, but they also offer options from Vanguard, Invesco, iShares, and a few others. Now, Schwab does tend to keep a higher amount of cash reserve instead of trying to invest all of your money, as they believe cash is a key component, and this can be as low as 6% up to 23% based on your allocations. Now, what I do find interesting about the cash component is I'm not sure if they're doing it to help you or to help themselves, because in their fine print, it does mention a conflict of interest where Schwab earns income on the cash allocations. So it would seem the higher the cash reserve, the more money they're likely to make. But if there's more money sitting around and it's not invested, that means less money you could be making. And I don't know this for certain, but this could play a factor in them not charging fees, because they're making money on your cash portion to where maybe they're making more than enough here, then they don't need to charge you fees. Because for example, if you had $100,000 invested with Schwab and you were in the aggressive growth profile, 6% cash is $6,000 in cash, and why are you not putting that to work for me? Now, Vanguard offers 4 different ETFs, and the allocation is going to depend on your risk, your age, and some other considerations as well. And it's going to be a mix of a Vanguard Total Stock Market ETF, a Vanguard Total International Stock ETF, a Vanguard Total Bond Market ETF, and a Vanguard Total International Bond ETF. And Vanguard only uses these funds, and there aren't other options from other institutions, so this is going to be a little bit more limiting. And from what Vanguard has mentioned, the allocations could vary from 100% stocks to 72% bonds depending on a number of factors. Betterment uses low-cost ETFs, and these include options like Vanguard, Schwab, iShares, and others, and they have 5 different plans or different strategies. One is the Betterment portfolio, another is a socially responsible investment, Goldman Sachs Smart Beta, a BlackRock Target Income, which is 100% bonds, and design a flexible portfolio. And on top of that, Betterment also uses fractional shares as well. So all of your cash is invested and working for you instead of having cash set on the sidelines. And I like that. And all the allocations are going to depend based on your selected risk tolerance. You could go all the way up to 100% stocks if you wanted to. And the design of a flexible portfolio, it's nice for somebody who wants to have more input in how their funds will be allocated. Then Wealthfront, it has 11 different asset classes that your money could be invested in, from US stocks to real estate to natural resources. And how your portfolio is split up is based on how you answer the questions about your risk tolerance. And just like the others, there are many ETFs to choose from Vanguard to Schwab, iShares, and others. Now, Wealthfront, they do not offer fractional shares, so you could have some cash sitting around not being invested for a period of time. Now, for investment options, I think Betterment may actually have the best one. The ability to select a flexible portfolio is great, and they're the only ones here that purchase fractional shares to make sure all of your money is working for you. I do think Wealthfront is right behind them with their investment options, and while Vanguard is limited for their portfolio options compared to the others, I do put it ahead of Schwab because Schwab just holds too much cash, which means your money isn't working for you in its full capacity. Now, performance is going to vary across the board. There are just so many factors, so to really get a true overall performance is a bit tougher to nail down. But Schwab, they do have some performance charts of their funds on their website, but these range from 4.1% to 7.1% for a 5-year return, which seems pretty unimpressive. I mean, you could just toss your money into VTI and it would outperform it. Now for Vanguard, I didn't see any charts for their performance, but this is definitely going to depend on your breakdown. With Betterment, they give projections on your return and what it could look like based on your allocations, but the actual performance is going to vary. Then Wealthfront, they do show their historical performance based on your risk score, and over the last 5 years, this has ranged from 7% to 12.5% for taxable accounts. Now, performance, it's going to vary, so it's really hard to pick one option as the best one, although Schwab's return looks to be just very low. Then let's talk tax loss harvesting, because tax loss harvesting is a great benefit that can help reduce your taxes that you may owe from your capital gains. And the overall idea is that you would sell an investment at a loss and replace it with a similar one. Then you would use the losses from the sold asset to help offset the gains from the newer one you just purchased. And Schwab's Intelligence Portfolio does offer tax loss harvesting, but you need $50,000 in your account before Schwab starts using this for you. So if you have just $10,000 in your account, you're not going to be eligible for tax loss harvesting. This goes for both the free version and the version for premium members. But you would think if you're paying for the premium version, you would at least get tax loss harvesting tossed in. For Vanguard's Robo Advisor, it does not offer tax loss harvesting, at least right now. Then Betterment, it offers tax loss harvesting to all of their customers, and there's not a requirement to the amount of money you need in your account in order to receive this benefit. They also reduce your tax liability by maximizing your charitable contributions. Then Wealthfront, they also offer tax loss harvesting for all of their customers, and there's not a minimum requirement in your account in order to receive this benefit. They also offer stock level tax loss harvesting and risk parity when you reach $100,000 in your accounts. Then you also get smart beta available when you reach $500,000 of investments. Now for tax loss harvesting, both Betterment and Wealthfront are ahead of Schwab and Vanguard because all customers get access to it and it doesn't require a certain amount of money in your investments. And Vanguard, they don't even offer it, so it puts them at the bottom of the section. Then rebalancing your portfolio is important to make sure your portfolio doesn't drift too high or too low from a certain allocation goal. And Schwab monitors your accounts daily and they'll rebalance your accounts automatically as they need to. That makes it super easy to prevent your portfolio from drifting. Vanguard's Robo Advisor will rebalance your portfolio when it sees an allocation drift of more than 5% from your recommendations. Betterment also monitors your accounts daily and they'll rebalance as needed when your account drifts 3% or more. Then Wealthfront, they also rebalance your portfolios when it is necessary, and they mention even doing it in a tax-efficient manner as well. And all of these options offer rebalancing, which is a great thing. Now, robo-advisors, they're not going to be for everyone, and that's fine. If you're someone who wants to have more say in how your funds are invested, or select individual stocks, or different allocations where you just want to do this yourself, well, these won't be for you. And there are plenty of options out there to help you invest. But for someone who might be new to investing or wants a lower cost option to a human advisor to make their lives a little bit easier and handle tasks like tax loss harvesting or rebalancing and do the legwork of using tax efficient ETFs, then a robo-advisor might just be for you. Now the things that really stick in my mind here are that options like Wealthfront and Betterment have no or minimal requirements to get investing on their platforms, and you get access to benefits like tax loss harvesting. But their fees are higher than that of Vanguard or Schwab. And Vanguard just seems too limited for what they offer compared to the other robo-investors. They have more limited ETF selections and lack of benefits like tax loss harvesting, plus you need $3,000 to get started with them. And their fee of 0.15% or 0.2% isn't really that far off from Betterment or Wealthfront. And both Wealthfront and Betterment offer more investment options and more benefits as well. In Schwab, while they highlight no fees and have a great fund selection, the fact they hold a higher amount of cash in your portfolio, it's a real turnoff to me. Because how much money is that costing you compared to a 0.15% or a 0.25% fee? Plus, they're benefiting from this, and I just don't like the optics of them making it seem like it's a benefit when it's truly not benefiting me. And their historical returns so far look pretty unimpressive. And Betterment really impresses me here with their fractional shares and making sure all of your money is being put to use rather than just sitting around. So any of these might be the right option for you. But even with their slightly higher fees, I do tend to lean towards Betterment or Wealthfront for their benefits that's accessible to all of your customers and easy access to opening their accounts. So tell me, do you use a robo-advisor? And if so, which one do you use? Now, if you're someone looking to earn $1,000 per month from portfolio dividends, then be sure to check out this video right here where I go over how much money you need to invest in order to make that happen. And if you want to support the channel, take a look at the links down in the description below. And if you know anyone that would find this video helpful, feel free to share with them. And until next time, take care.